Today, I want to talk about one of the most powerful shifts happening in the world of real estate investment, a quiet revolution that's changing where the smartest money is going. For decades, property investment meant one of three things: offices, retail, and residential. Those pillars have shaped portfolios for generations. But over the past few years, and especially after the pandemic, that foundation has started to crack. Investors are asking new questions. Where will the next growth come from? Which assets will survive technological disruption? And where can I find resilient, long-term returns in a volatile world? The answer increasingly lies in alternative real estate assets, logistics, data centers, and purpose-built living. The global real estate market is worth over $300 trillion, bigger than the stock and bond market combined. But the composition of that market is changing fast. Rising interest rates have challenged traditional buy-to-let models. Retail is still recovering from the e-commerce boom. Office occupancy is struggling to return to pre-pandemic levels. Meanwhile, demand for logistics hubs, data center space, and high-quality housing is exploding. Institutional investors are allocating record amounts of capital to these alternative sectors, sectors that just a decade ago were seen as niche. Let's start with logistics real estate, the unsung hero of the e-commerce revolution. Every time we click buy now on Amazon or Shein, a network of warehouses, fulfillment centers, and last mile hubs comes to life. That network depends on property, modern, strategically located industrial space. The pandemic exposed just how fragile global supply chains were. Now, companies are re-engineering their logistics systems for resilience and proximity. This has created enormous demand for new warehouse capacity near urban centers and transport corridors. According to JLL, the global logistics real estate market is projected to grow at nearly 7% annually through 2033. Vacancy rates are at historic lows in cities like Los Angeles, London, and Singapore. What's driving this? Three words: e-commerce, efficiency, and ESG. Retailers want speed. Manufacturers want control. Consumers want convenience. And investors want stable yields, often 6 to 8%, with strong capital growth potential. Logistics real estate has gone from being a boring industrial play to one of the most dynamic, in-demand investment classes worldwide. Next, let's move to data centers, the physical backbone of our digital age. Every photo uploaded to Instagram, every Zoom call, every AI model, it all lives somewhere. And that somewhere is real estate. Highly secure, climate-controlled facilities housing millions of servers. Data consumption is growing exponentially, not linearly. Cloud adoption, streaming, 5G, and especially AI are driving demand for data center capacity faster than anyone predicted. Today, data center REITs are outperforming almost every other property sector. Global players like Equinix and Digital Realty are expanding aggressively across the US, Europe, and Asia. For investors, these assets offer long-term, inflation-linked rental income, often through 10 to 20-year contracts with blue-chip tenants like Amazon Web Services, Google, or Microsoft. The challenges, of course, are energy and sustainability. Data centers consume vast amounts of electricity and water, making green infrastructure investment a growing priority. But that also opens a new opportunity: renewable powered ESG compliant data campuses are becoming the next frontier in sustainable property. The third major opportunity is what's broadly called living, purpose-built housing that includes multifamily, student accommodation, and senior living. Globally, there's a housing shortage in almost every major city. Populations are growing, people are living longer, and younger generations are renting longer than ever before. This combination creates a structural imbalance: high demand, limited supply. Purpose-built rental housing offers consistent occupancy, predictable income, and resilience through economic cycles. During downturns, people may cut discretionary spending, but they don't stop needing a home. Student housing and senior living, in particular, have shown counter-cyclical strength, even during recessions. For investors, the living sector provides reliable cash flow, social impact potential, and alignment with ESG goals, especially when focused on affordability and sustainability. Of course, no opportunity is without risk. Rising interest rates and construction costs remain key challenges. Some markets are experiencing oversupply. Regulatory shifts, such as rent controls or data sovereignty laws, can also impact returns. But overall, global capital flows tell a clear story. Institutional investors are pouring billions into these sectors. The Asia-Pacific region now accounts for almost 40% of all new data center investment. North America dominates logistics, and Europe is seeing a surge in build-to-rent projects. Diversification is a new defensive strategy. By spreading capital across geography and asset class, investors can capture upside while managing volatility. So, what's the takeaway? The future of property investment isn't just about buildings, it's about infrastructure, innovation, and inclusion. Logistics connects the physical world. Data centers connect the digital world. And purpose-built living connects communities and people. In short, the smart investors of tomorrow are already moving beyond traditional real estate toward assets that define how we work, live, and connect in a rapidly changing world. Thank you.